Alright, A plus traders, this is the last module of the price action course. This is the module 4, and here in this module we are going to discuss about risks and money management techniques. So many traders jump into trading without applying proper risk management, and they don't even know how to manage their money, and at the end of the day they end up burning away their whole funds in the trading account. They blow the account. It is very, very bad. So in this module you are going to learn what is forex risks, the best risk to reward to use, how to manage your losses and how to manage your profits. You also learn a special concept I name circuit breaker concepts. This concept is to help manage emotions and losses too. So we are going to learn all this in this last module of the price action course. But before we begin, I want you to subscribe to this YouTube channel, A Plus Trading Hub, and hit the notification bell so you don't miss any of the updates we will be updating on this channel. So click the notification bell, subscribe to this channel. Let's begin. So risk is simply the potential loss which happens if price moves against your projected trade direction. Risk management are precautions and strategies taken to reduce the loss of trading capital. So stop loss are part of the risk management precautions. Hedging is one of the strategies, and money management is one of the precautions too when you are trading. The simple definition of money management is capital preservation. In trading, if you can't win, you should not lose your money. That is the simple rule in trading. If you cannot win, don't lose your capital. It's better your capital is safe for you to trade another day. Maybe you may make a profit, but if you lose your capital, you are done. So that is why risk management is very, very vital in trading. So many mentors, so many trainers, so many coaches ignore risk management. And if you can see, risk management in my ranking is one of the first in all my courses. This is the price action course, and it's the fourth module. All my courses I emphasize on risk management. In the Pro Traders course, we discuss more advanced techniques on risk management, the aging techniques, because the aging techniques is a more advanced techniques to manage risks. Stop loss is simple to use, and money management is also simple. So we discuss this aging technique in the Pro Traders course because it's a more technical strategy to use in managing your risks. Risk management is the only holy grail in forex trading. According to research, over 87% of traders lose money because of poor risk management. This is true. So many traders who are losing money won't be losing their whole funds, who are blowing their account if they apply proper risk and money management in trading. It's not about your trading strategy. You may have the best trading strategy, but with the wrong risk management or money management technique, you still end up losing your capital. So I emphasize you pay more attention to this particular module and all the lessons in this module. You don't need to risk too much when you are trading. So this is the only holy grail in forex trading, risk management. So don't forget that. Anytime you wake up to trade, consider risk management first. The best position sizing for you to use, you should be risking 1 or 2% per position. For example, you want to take a trade, maybe you want to buy Euro USD. Your risk on that particular trade should not exceed 2% of your capital. For example, let's say your account balance is $2,000, 2% risk is $40. So whenever you are taking a trade, don't risk more than 2% of your trading capital on a particular trade. Then equity sizing, overall open position. Let's say for example you have 5 trades running on your account. The overall risks on those trades should not exceed 10%. It should be between 5 to 10, but it should not exceed 10%. Personally, me, I do 8%. So I can't take a trade, then all the trade is over 10%. I'm a conservative trader. So if you are aggressive, you can take it to 10% risks of all positions. So for example, let's say you take 5 trades and all of them are not yet on profit, they are still running in a loss, and you know that if altogether, if the 5 trades should hit your stop loss, you will not lose more than 10% of your account. So what you do is you just be monitoring the trade. Once, let's say 2 or 3 are in profit and you set break even, like you move your SL to your entry, you can now take new trades. So that is how you trade. You first of all allow the trades to run. When it moves at least 50 pips in your favor, that is when you move your stop loss to your entry and you break even. So when you break even on a trade, on like 2-3 trades, you can take new trades for the day. So that is how you manage your risks. You don't just because maybe you see you are in a signal group, or maybe you see signals, you get signals from me and I gave up to 10 signals. That does not mean you should take all the 10 signals. Just pick like, let's say 3 or 4 of them and trade. So when out of maybe 4, 2 are in profit, you can take the remaining ones. So that is how you should be managing your risks. So for risk to reward, if you use 1:2 risk to reward, it is good. If you use 1:3 risk to reward, it is very good too. If you use 1:4, better. If you use 1:6, it's great. But this is rarely seen. 1:6 risk to reward, except you are a long-term investor or position trader. You are ready to wait for maybe up to 2 or 3 months for your trade to reach your take profits. You can do 1:6 risk to reward. So this risk to reward means what you risk is to what you gain. Then 1:2 means that, for example, you are risking $1 to earn $2. That is, you are earning times 2 of what you risk. 1:3 is that you are risking, let's say, $1 to earn $3. That is, you are earning times 3 of what you risk. So me, I really recommend you use 1:3 when you are trading. But first, let's do a little calculations on that risk to reward. So this is a comparison between 1:2 risk to reward and 1:3 risk to reward using a $100 trading account. If you look at this table, from here to here are trades that we took using a risk to reward of 1:2. Then from here to here are trades being taken with 1:3 risk to reward. So this is a $100 account, and on the first segment here we risk $20 to earn $40. That is 1:2. So let's say we took 5 positions, the second position, third position, and the 5th position. We took 5 positions, risking $20 to earn $40. That is 1:2 risk to reward. And in the worst case scenario, you lose 3 trades and win only 4 trades. At the end of the day, you'll be left with $80 and you are in a loss because you only made $80. 40 plus 40 is 80. So that is your total profit you have now. You are now in a loss. You are in $20 loss. You lost $20 of your equity. But let's look at this other side. Let's say you risk $20 to earn $60. That is 1:3 risk to reward, and we took 5 positions. Then in the worst case scenario, you lost 3 trades and only 2 trades hits your take profits. At the end of the day, you earn $120, because 60 here plus 60 here is 120. So you see that you have recovered these losses you made here and still made profit on top. So you have made a profit of $20 if you are using 1:3 risk to reward. So you can see how this works, the risk to reward works. So it's better you use 1:3 risk to reward anytime you are trading. At least 1:3 risk to reward. You can do more than that. You can do 1:4, 1:3.5, or 1:4.7. You can do more than that, but at least do 1:3. So in a worst case scenario, you lose more trades, the few trades that will hit your take profit will still preserve your capital and still give you a little profit. That's why I campaign and I advise that you use at least 1:3 risk to reward when you are trading. So use 1:3 risk to reward each time you take a trade. So if you are taking a trade, if you see a trade setup and the risk to reward is not up to 1:3, you forget about that trade. There are so many opportunities in the market, so you don't need to beat yourself because one particular trade setup does not meet up your risk to reward. So you forget about it, open another currency pair and scan through it. You may see 1:3 risk to reward. In your trading plan, you need to include that if a trade is not up to 1:3 reward, you not take the trade. This is the only way to stay safe in trading. You need to make sure you develop a good trading plan. Infuse this your trading rules and goals into your trading plan, and you'll be safe. 1:2 is good, but 1:3 is better. Always take partial profit and set BE. I've discussed this earlier. Anytime you are trading and the price moves in your favor, at least 50 pips in your favor, take partial profit. For example, let's say you are buying, this is your entry here, and this is your stop loss below here, and your take profit is up here. Let's say price moves in your favor and moves at least 50 pips. When price moves at least 50 pips in your favor, you move your stop loss and place it at your entry. That is how you set BE. That is, your stop loss price now will not be the same as your entry price. So in case price wants to push down and retest your entry before continuing moving up, it's not going to take you out on stop loss, rather it's going to take you out on a little profit. Anytime you are trading, make sure you are managing your trade well by setting BE or trailing your stop loss. You need to understand that loss is part of this game. Any trader on earth that tells you he makes consistent profit, like he doesn't lose on any trade, all his trades are always in profit, it's a lie. It's a lie. It's very hard. At least you will lose small and you win. As a trader, you have to make sure your winning trade exceed your losing trade. So you may take 10 trades and you lose 6 trades, while you make profit on 4 trades. So that profit, now the profit on the 4 trade has to exceed the losing trade. So that is how you make money in the game. So you need to understand that losing a trade is part of this game and respect that fact. When a trade hits your stop loss, you don't have to panic and start hitting yourself. You need to calm down, scan the chart, make your market analysis very well, then continue trading. Anytime you want to trade, you need to apply the 60-40 preservation rule. Now, this 60-40 preservation rule is what I advise beginners traders to apply whenever maybe after you have mastered your trading skills and you have mastered your emotions and you want to start trading. Let's say you have $1,000 to start trading with. Now, you deposit this $1,000 to your broker and it will reflect on your back end office, like your wallet. So you need to transfer only 60% of this 1,000, which is $600, into your trading account. So you transfer $600 into your trading account. So when this $600 enters your trading account, $400 will remain in your wallet. So this $400 is for emergencies. What I mean by emergency is, let's say for example, you, due to pressure, maybe emotions, you took so many trades, and let's say majority of your running trades are losses, but your account is still alive. Then maybe you have a drawdown of over 50% of your equity. You have over 50% drawdown, so you can now move this remaining 400 now back into the trading account to hold the retracement. So when everything gets back to normal, when you start making profit again, you withdraw that 400 again back to the wallet. So that is a 60-40 equity preservation rule. Don't trade with all your funds. Take 60% of it to the trading account and trade with it, while 40% stays inside your wallet for emergencies. Think of where you may have gotten it all wrong. So whenever you trade and your trade hits your, don't start crying or panicking. So you need to look at that trade setup again and see where you got it all wrong. Is it you made a mistake on fundamental? Was it a wrong trade setup? Was it impatience? Was your stop loss very tight? And the rest of them. You take all these things into consideration and you make sure your next trade setup you are going to get, you make sure you avoid these mistakes. Accept small losses by placing stop loss at obvious level, which will invalidate your trade setup if price gets to that level. So for example, let's say you see a bullish flag, this is a trade setup. Your stop loss don't have to be on the retest. When price retests and you take an entry, your stop loss should not be so close to the retest. That's why I say let it be at least 50 pips away from the signal. So you see, now is in an obvious level where if price should go and hit it, that means your setup is being invalidated. So always make sure your stop loss is at obvious levels. Then anytime you have up to 50 to 60% drawdown, sometimes you may experience such drawdowns as a new trader, as a beginning trader. So that is when you move your emergency funds, the $400 I discussed earlier, to your trading account to hold the drawdown. So when the drawdowns are okay, they are no more crazy, you refund it to the wallet. So these are few tips on how to manage losses. If you are able to apply all these things, there is no way you will blow your account. There is no way you will lose your entire capital. As far as you apply these things I'm saying here, there is no way you lose your entire trading capital. So this is also how you manage your profits. Overconfidence kills, because maybe a particular trader hits your take profit and you find yourself and say, oh, I'm now the king of the market. The next trade you won't calm down and analyze and do a multi-time frame analysis. You don't come down to look at if prices are key levels. You just jump in and buy or sell. That is overconfidence, and it kills your trading account, it kills your trading career. So because you win a trade does not mean you need to be overconfident. You need to calm down, be humble, and continue trading. Then always follow your trading plan. This one, I don't play with it. Anytime I see a trade that's not fitting into my trading plan, I don't take the trade. So it will be good if you also follow this step. For example, let's say your trading plan says you should be trading only London and New York session, and maybe you woke up at night during the Asian session, you see a very nice and sweet trade setup. You don't take it because it's not according to your trading plan. Your trading plan was London and New York. So even if you see a good setup at the Asian session, you should not trade it. So that is, you need to be very disciplined with your trading plan. Let me give you another scenario. Let's say your trading plan says you should be risking only 2% of your trade, 2% of your trading account per trade, 2% of your trading account per trade. Then you see this very good setup and you are like, wow, this is the best trade setup I've ever seen, and you want to increase your risk on that trade to, let's say, 3%. This is wrong. You shouldn't do this. That means you are going against your trading plan. You don't have to do that. You need to follow your trading plan. Anything that is against your trading plan, don't try it. Then don't enter a trade unless a perfect analysis is carried out and the setup is a very high probability setup, at least 75 to 80%. So if you see a trade setup and after all analysis have been done, the probability that is going to hit your take profit is not up to 75 or 80%, don't take the trade. It's as simple as that. Just leave it alone and look for another trade. Then once you double your account, this is what I do very often. I do this, I don't play with this. Once I double my account, I withdraw my capital and trade only with the balance. Let's say you have a $200 account and you double the account, like you make at the end of the month, or let's say in a week or within 2 months, you make 400, you make extra 200, making the account 400. Withdraw the capital, the 200, back to your wallet. Because if you allow the whole funds, both the capital and the profit, to be there, this will make you increase your loss size and overconfidence may come in, and at the end of the day you blow your account. So all you need to do, withdraw the money back to your wallet, or you go take some chill pills. You need to enjoy your money now, so you can withdraw, let's say 200, you take maybe 10 or 20% of this money and go buy yourself some nice clothes or take some good wine. Then the remaining 200 on your account, you repeat the same steps from step 1 to 4 in managing the trading funds, in trading. So you need to start trading the current balance now, which is the 200, as if it is a new trading account. You repeat all the steps you have been doing, that same steps you did to double the account, you repeat all those same steps again. So that is how you manage your profits. And these are few risk management precautions I always recommend for any trader. 1, you need to know your risk tolerance. We discussed this in 3rd lesson in this module. Sit down and think, how much can you lose, and you don't panic and you don't worry about it. That's what you should be thinking of, and that is how you know your risk tolerance. For example, let's say you have $200. If you know if you have $200 and you lose $20, it will be painful to you. That means your risk tolerance should not be up to 10% of your account. So it's as simple as that, because $20 is 10% of $200. So let's say you have a $200 account and you lose $20 and it's painful to you. That means your risk tolerance is very low. So your overall risk tolerance should be reduced to at least, let's say, 5%. So these are what you use to gauge your risk tolerance, to know your risk tolerance. So like me, my risk tolerance is 10% of their trading account. Though sometimes when I'm taking a trade, I don't allow my exposure to exceed 8% of the account, because I'm very conservative. So you need to understand your risk tolerance. Know the amount of money that if you lose, you will feel very pained. So when you know that amount of money, you can now say, okay, fine, since this is the amount of money, convert it to percentage. How many percentage will it amount to my trading account? Let's say you have a $100 account, and if you should lose $20 in that account, it will be very painful. So you have to make sure all the trades you are taking, none of them will make you lose up to $20 or up to $10. It should be less than that. So that is how you determine your risk tolerance. Then determine your exit levels before taking a trade. Because you see a trade setup, a nice trade setup, and you jump into it to the trade. No, you need to determine first your stop loss. The number 1 thing you should determine is your stop loss, where price should take you out of the trade if it reaches there. So that is your stop loss. You determine your stop loss first. After your stop loss, you look at your take profit. So if you see a trade setup and you can't determine your stop loss and your take profit, there is no point taking that trade. Then you need to avoid aggressive trading. Not because you lose 50% of your account, or let's say 10% of your account, and you start being aggressive. You start trading like you have to make back this money. Trading on impulse, that is being aggressive. You don't need to be aggressive when trading. So if you lose money and it's really affecting you emotionally, I would advise or suggest you to stop trading for some time and go and clear your head. As in, the market don't care about your emotions. The markets don't know you. They don't feel pain for you. So if you are being aggressive, at the end of the day you still lose your whole money. So you don't have to be aggressive when you are trading. Even your trading goals needs to be very, very realistic. Let's say you have a $100 account and you are setting a goal like you want to make $1,000 from the $100 account within 3 days. That is a very, very unrealistic goal. You need to be setting goals like, okay, I want to make between 10 to 50% of my trading balance within a month. That's realistic. So you set realistic trading goals. Don't be doing unrealistic things with your trading account. It won't help you. So avoid trading on impulse and over trading, because it's the fastest way to lose your money. Get this into your head. Anytime you are trading, make sure you avoid trading on impulse or taking too many trades. Because if you do this, that means you are going to lose your capital very soon. So another risk management precaution is you need to admit when you are wrong and move on. You don't need to win all your trades. So when a trade hits your stop loss, my brother, my sister, just admit that you made a mistake and move on. Because if you continue hammering, looking for why you lost that money, that particular trade, and you need to make it back immediately, that is when you get everything wrong. So ideal equity risk is between 5 to 7%, maximum 10%. Mine is 10%, but sometimes I manage to drop it at 8 until when my trades are in profit before I add more trades. So don't forget to apply the 60-40 equity preservation rule. Here is the main concept of the circuit breaker. I call this the circuit breaker concept. And if you see, it has a percentage and a time on it and a duration on it. So this is what I do to help me clear my head when I'm trading. Anytime I take a trade and I lose 3% of my trading capital at a stretch, I don't trade for the next 1 hour. Then if I lose 5% of my trading capital at a stretch, I don't trade for a whole day. If I lose 7% of my trading capital at a stretch, I don't trade for 1 week. These are a way of making sure I let go of all the emotions. So I will suggest to you apply this to your trading. Also infuse it to your trading plan. It will help you, especially if you are a day trader. It will help you. As a swing trader, we don't really have issues with this, but as a day trader, this is good to manage your emotions and your mindset. So apply this to your trading too. It is very good, very, very good. If you lose 3% of your account, take a break and relax for at least 1 hour. If you lose 5%, take a whole day. If you lose 7% of your account, take a week. Just relax, go leave the market, close your MT4, if possible uninstall it so that you won't be tempted to look at the chart. So you don't look at the chart for a whole 1 week. Then when you come back and see what has price been doing ever since, then you have a clear head. You let go of the losses and everything. Because if you don't do it and you come back with a revenge trading mindset, the market will show you paper and you lose everything. The number one problem of every trader is emotions derived from watching a losing trade turn deeper against them. So you need to cut your losses and ride your winning trades. So it's better you lose $20 than to lose $80 on a particular trade. So always cut your losses when it's small, as by risking small, like using a small stop loss. Then make sure you ride your winning trades. Here is a few quiz for you. I attempt this question is good for you. At least this will help track the progress, your learning progress. If you should you try attempting any of these questions and you can't answer them, that means there's something you miss along the line you are going through this course. So you go back and begin the course again. You may be a beginner trader and you may not understand all the terminologies or what I'm saying by just going through the course once. So the course is there for you. You paid for it, so you can go through it over and over again at your own pace and attempt to answer all the questions in this course. That is the only way to track your progress. So answer these questions. If there is anything you don't understand, you ask me. You ask me, comment on the video, and I'll look at your question and give you more explanation and give you more examples, so it makes it clearer to you, makes you understand better. Remember, if you risk small, nothing can destroy you, and this is true. If you are risking small in any trade you take, there is no way you can lose your trading capital. That is the truth. And if you are interested in the Pro Traders course, in the Pro Traders course we discuss some other trading strategies like the swing trading strategies. We discuss how you can use the pivots and how you can add the price level trading to your strategy too. If you want to learn more about the Pro Trader stuff, you click on the link below this video. So don't forget to subscribe to this YouTube channel, A Plus Trading Hub. You can follow us on our social media, Facebook, Instagram and Twitter. If you want to discuss with me directly, you can send me a message on WhatsApp. Don't forget to subscribe to this channel and click on the notification bell.